While everyone is busy talking about models, chips, and the future shaped by artificial intelligence, a quieter shift is happening beneath the surface of the market. Some of the more disciplined and patient capital is not following the crowd into the hottest trades. Instead, it is slowly rotating toward assets that have been ignored for years. This shift may not look exciting at first glance, but if you step back and observe over a longer period, you start to see a consistent logic forming behind it, often referred to as the halo approach. It is not about rejecting technology, but rather about recognizing that technological progress reshapes how value is distributed across the economy as more industries become digital and asset-light. The importance of real tangible assets begins to stand out even more, because they represent constraints that cannot be easily replicated. Things like infrastructure, energy supply, industrial capacity, and stable cash flow streams start to gain renewed attention. This has already been reflected in parts of the European market, where certain traditionally overlooked sectors have experienced meaningful revaluation, not driven by hype, but by a reassessment of balance sheets and long-term earnings visibility. Japan offers another interesting case. For decades, many companies held large cash reserves without effectively returning value to shareholders, which suppressed their valuations. But as regulatory guidance and market expectations began to shift, these companies started improving shareholder returns through dividends and buybacks. Once capital efficiency improved, the market responded accordingly. What looks like a revival of old economy sectors is in reality a delayed correction of long-standing mispricing. If you then bring interest rates into the picture, another layer of nuance appears. Many assume that rate cuts are universally negative for banks, but the reality is more complex. For certain banks with stable asset structures and improving funding costs, combined with a manageable credit environment, rate cuts can actually support valuation recovery. This reflects a broader shift in how markets interpret macro signals, moving away from simplistic good or bad narratives toward more granular structural analysis. When we look at China, the situation becomes even more layered, because the market simultaneously hosts both high-growth sectors and deeply rooted traditional industries. This coexistence creates natural mispricing opportunities. Some companies continue to be labeled as cyclical or outdated, yet their asset quality, cash flow, stability, and shareholder return potential may have fundamentally changed. The market has not fully repriced them under a new framework, and in Hong Kong, the effect can be even more pronounced due to liquidity conditions and sentiment swings, where price movements often diverge significantly from underlying fundamentals. In such an environment, taking a longer-term perspective on asset value and return characteristics can reveal opportunities that are not immediately obvious. However, it is important to understand that halo is not simply about buying anything that looks old or heavy. The key lies in two factors: whether the assets themselves have real scarcity or irreplaceable characteristics, and whether the companies owning them are beginning to return value to shareholders in a meaningful way. Without these elements, heavy assets alone do not automatically translate into investment opportunities. So the distinction is not between old and new, but between mispriced and fairly priced. For individual investors, the more practical takeaway may be to avoid extreme positioning between growth and value, and instead recognize how their relative importance shifts over time. When market attention becomes overly concentrated in one direction, it often means that risk compensation is improving elsewhere. The goal is not to predict which theme will dominate next, but to build a portfolio that can remain resilient across different environments. This may include both growth-oriented assets that represent future potential and cash flow-driven assets that provide a foundation of stability. Such a combination may not appear aggressive, but it is often more aligned with long-term sustainability. In the end, markets do not permanently favor a single narrative. When one story is pushed to its extreme, another is usually quietly gaining strength in the background, and the idea behind halo serves more as a reminder to revisit what has been overlooked, rather than simply chasing what appears brightest at the moment.